Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I in Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker dealer. That's what we're there for, to give you advice, provide you guidance. There's the disclaimer.
Alrighty.
I'm going to share my screen while I'm doing that. If anyone's joining us for the first time, Will and I, we do these shows in the morning to help answer any questions you may have about Market Chameleon tools, data, analytics. If you want to come on the show and ask your question live, we have a link to Zoom. Click on that link. Once you get over to Zoom, click on raise your hand. When we let you in, you could ask your question live and direct. If you prefer to ask your question by typing it in, you could also do that by typing it into the chat box on YouTube. Will's watching it, he'll read it back to me. So while we're waiting for more people to join us and for questions to queue up, what we'll start out with is looking at the pre-market report for stocks that are trading in pre-market hours, see if we could get some insights, what's going on there. And then if questions come in, we'll take those questions. If we don't get any questions, I'm going to default to some questions that I've been getting throughout the week over the email. So I'm going to try to take those if we don't get any live. All right.
Awesome.
So, pre-market report. These are stocks trading in the pre-market hours. I'm going to scroll down here. We've got a list of our most active stocks, a list of our biggest percentage gainers, biggest percentage decliners. Down here, I see 161 stocks made our percentage gainers list, 69 on the decliners. So from this perspective, looks like we're setting up for a more bullish bias at the open. If we look at this list, we will see that there are stocks in there that are small cap stocks. You have ETFs in there, leveraged ETFs, closed-end funds, preferreds, anything that's listed on a major U.S. exchange. If it's trading in the pre-market hours and meets our thresholds, it can make this list. And what we want to do is start narrowing down this list to a smaller group of stocks. And to do that, we'll use the filters here above. I'm going to start with this one in ETF. Click on that, get a drop-down list of ETFs. The top ones are broad-based ETFs. We've got some sector ETFs, but let's go to the SPY. That's the S&P 500 ETF. When we click on that, you see that the list below got filtered by stocks. These are symbols that stocks that are holdings in the SPY ETF. And that's the S&P 500 constituents. Here we see 51 stocks made our percentage gainers list, 6 on the decliner. So right now we are lining up for a more bullish bias at the open. And, you know, one of the things is interesting, Will, that a lot of things you read from economists are forecasting this, you know, that we're going to fall into a recession really quickly and that the Fed will start cutting rates almost, you know, immediately this summer. You know, some of them are pricing in by this summer, but definitely this year. And right now, all the indicators are, you know, the stock market, it's pointing to growth, you know, because the stock market itself, the valuations are forward-looking, forecasting to the future. You know, they're pricing in growth. The labor market still is very strong. Yet we did have regional banks that were doing poorly, but they're not doing poorly because of the, you know, a poor economy or poor market conditions. It was more of their, you know, mismanagement or lack of foresight that interest rates can move higher, right? So the banks that are in trouble, it's not stemming from, you know, external economic conditions as much as that their assets, their portfolio, their management of their risk did not anticipate that interest rates could go higher, and that that their deposits they could lose deposits because their customers will go and seek higher yields somewhere else. So that's right now it's an interesting situation where we have the bonds and equity markets kind of, I believe, are in odds of their signals. They're signaling something very differently. And if you look at gold and silver, that are, I think gold is multi-year high, silver is going up, those are also, signaling that either there's going to be dollar weakness, or, people are hedging against, some inflation. So we're not getting like this really big deflationary signals out there that you would think. So just something interesting to watch. Of course, Apple came out with earnings up 3% after hours. So that's a big tech stock there. They're talking, today I'm sure they're going to have like lots of questions about, technology, AI, and so forth.
Yeah, it's interesting. Rob says AMD had a nod from Morgan Stanley yesterday as a major player in the AI field, and we do keep talking about this AI. And I was actually at my wife had booked us. I forgot to mention it yesterday to you. We went to a concert yesterday, and the band's called Hoodoo Gurus, but they were like an Australian punk band from the 80s. Yeah. So the crowd was like all people our age and older, who you could imagine were like, punksters, and back in the 80s, 90s were like, young rock and roll, groupies basically. And it was amazing. And this is an older generation, right? It was amazing to me looking around at the crowd, how many people were taking videos and pictures throughout the whole event. And you just think about all those pictures are stored, right? Their catalog. It's not free, right? All that information that's being, saved is not free. And it's the same thing with, we're talking about AI, right? All this is done. It's huge processing capacity. There's a cost to it. Both, in energy, in equipment. It's, everything we do now with our phones, and, I don't think people think about it. And I know I don't a lot about the energy, the resources it uses to be a part of our lives, right? Yeah.
And that's part of something as a society right now. We're just accepting that for getting something for free or at a discount, we're giving up our privacy, right? We're giving up information about ourselves, some of our privacy, some of the things that we don't even realize is being captured and monetized and analyzed somewhere. And that's right now, this is the trade-off. I'm sure even iPhone, that is a big tracking system. I mean, how much would an iPhone cost if that wasn't allowed, right? If they weren't able to monetize, our habits, locations, or our interests, all that. So but that's where we're giving up that value, and that's what's paying for some of this free stuff, right, that we're getting with access to these softwares and apps.
No, it's amazing.
So let me see if there are no questions. I'm going to default to a couple things that came up. Somebody did ask, if I'm looking at a call spread, bull call spread, debit call spread, or let's just go to SPY. What are the advantages or disadvantages of a bull call spread versus a credit put spread? And they should be mirror images of each other, right? So bull call spread on the same strikes is should have the same risk profile as a credit put spread on the same strikes. Or you could create an arbitrage, right? But some differences could be the following. When you do a in the money call spread, right? So let's say we do this in the money call spread in SPL. So we, buy the 395 call, sell the 400 call. This will be a bull call spread. And it should mirror what a credit put spread would be on the same strikes. The potential advantage of doing a credit put spread versus a call spread, if all things being equal, if the options line up correctly, is that you're anticipating that the stock is going to be above, in both situations, above that 400, right? So it's 405, you're anticipating that that's your bet that it's going to stay above 400. If you do a credit spread, what happens is then, if that's the case, both puts expire worthless. So you just keep that credit. In a call spread, both calls are in the money, so one is assigned, the other one is exercised, and there could be a commission incurred for that. So even though the payoff is the same, you may end up paying commissions, because when an option expires worthless, nothing happens. There's no assignment or exercise. It just goes away. So you don't get this commission when potentially, your broker could charge you some commission based on, those exercises assignments. Another thing, to look out for is when you do a call spread and there's a dividend, or it could be a different kind of corporate event, but especially a dividend, when it's in the money, you have to remember that if it's deep in the money, it could become one of your legs, both the legs, but the one you own could become an early exercise candidate to exercise the call prior to the dividend, so you could convert it to stock and receive that dividend. Of course, you got to make sure it's an exercise candidate and that it's deep enough in the money that it makes sense. But you'll have to remember to do that, because if you don't, and it is an early exercise candidate, and if you don't exercise it, then in that situation, you miss out on the dividend, and you would have been better off doing the put spread, because that one would have been already priced in. In a call spread, it's assuming, the model's assuming that you're going to exercise that call if it's a candidate for an early exercise. Okay. So a couple advantages and disadvantages. Of course, if you also do a call spread and you own the stock that has long-term capital gains, you got to be careful with that, because once you're assigned, they could look at it as a tax event. So those are kind of things to look out for in theory. If you do everything in the perfect world and you're an efficient trader, there shouldn't be, there shouldn't be a advantage or disadvantage, but in reality, there are some, okay, due to commissions and early exercises and so forth. Okay, so that came over the email. There's another, I do get questions sometimes. We talked about trying to create a fair value for stocks. And we talked about pricing models. What do we think, the fair value of, stock prices? Hold on. And, there are different models to try to create that fair value. And when we try to put in a value on an asset and we run a model, there's nothing really, that we could count on that it could exactly with mathematical precision say this is the exact value of the stock. All right. That's not how it works. We create models to try to create estimates of what is a reasonable price for this stock. And there are certain concepts that you could take to try to run those models. So before we talk about this model, before we talk about our models, I need to kind of maybe explain some of these concepts. All right. And there are different concepts and there are different models to try to map out, well, what is a fair, value? And I'm going to start out, like, let's right now put the stocks to the side because they're harder to price, but there's models where you could start observing things, right? So these are things that, you could start observing and creating a simple model just from observations and then making it more complicated. And I'll start out like with a exchange rate. So right now the exchange rate, let's say from US dollar to euro is, what is it, like 110? Well,
yeah, right around 110.
So here it is. So let's just start with this US, and I'll tell you why I'm starting with this versus euro. And I think the exchange is like 110. All right. So, okay. So let's say I'm in a big bank, JP Morgan, this. So, okay. I want you to create a model to trade this. Right. So now I have to sit there and say, okay, well, I see that these are the 110, those are my inputs, but somehow I have to use other, things available to me to come up with what I think the exchange rate should be. And then compare that to this market price. So that's the market price, right? How do I make this go away? Why is this here? All right, okay, there we go. So this is the market price, right? This is the market price or market exchange rate. And then I have to come up with a theoretical one to see how do I trade it, right? So it's theoretical, price. So then what I do is I could start building out my model very simple, right? And I'm going to say, okay, well, I'm going to use a concept called purchasing power parity. Okay, and purchasing power parity says the following. Well, if I say, here's an iPhone in the US, yeah, and then there's an iPhone in Europe. Come on. Isn't this? Okay, and in the US, it cost me, let's say, $1,000. And in Europe, it costs me, 1,000 euro to buy a phone. Well, if I make this observation, I say, okay, well, this implies that the exchange rate should be 1-to-1, right? Because if I take my US dollars and if I buy an iPhone here, right, buy it, and then I go and sell the iPhone, what happens? Well, I started with $1,000. I flew to Europe and I ended up with 1,000 euro. Well, if I take that 1,000 euro and go to the market exchange rate, I get $1,010. I'll end up with $1,100. So then by my observation, then the market price is mispriced based on this first initial model. Okay, so everybody sees that. So what I'm doing is trying to say, okay, well, if I look at this rate and this is suggestion should be 1-to-1. Well, this is mispriced because theoretically, I could just keep arbing that. And in reality, of course, there's sales tax and it's not frictionless, right? Tariffs and so forth. And then, so, Mr. Morgan at the bank says, okay, we'll start developing more. So then I go do a basket of goods, right? So you could see how this could develop. So then I take a basket of goods and say, all right, give me, iPhones, plasma TVs, Rolex watches, whatever it is, whatever I could observe, create a basket of goods, track it, and then you get a high range and low range, right? So this would be a theoretical, theoretical, model. And even though I can't price it with precision, I could kind of get an idea, where do I think the prices should be? And then I could observe how far away the market prices tend to move away from my model and pick ranges where it may have gone, too low or too high. So this model that I just showed you is based on things that I could observe, right? These are like prices that I could observe, and they're out there, and I could input them into my model, and then it'll tell me, what the model thinks this should be versus what the market prices are. But with stocks, they're forward looking. So the problem with stocks is now, I could say, okay, here's stock A, and here's stock B. And let's just say, I don't really care what they do. One could make pencils, one could make rubber bands, right? But if one makes, $10,000 in earnings, and one makes $15,000 in earnings, so stock B should be 50% more I should pay, because I get more earnings, right? They're going to pay me back more in earnings. And however, when stocks are priced, they're not priced on past earnings, it's forward earnings. That means now I need another model, right, to forecast earnings growth. And this is where it becomes very tricky, because we don't know, I have no idea. Nobody, analysts try to pick it, but we don't know what, Tesla's earnings are going to be the next 5 years. We have to guess, we have to make an estimate of what we think it's going to be. And those models themselves have lots of assumptions, right? So now we have lots, of assumptions about earnings growth, because we have to, what is their earnings, the sensitivity to interest rates, sensitivity to, market conditions, to employment and all that. Okay. And, when we create these models, these fair values, you have to take it with a grain of salt. There's no, exact precision, because sometimes people will be like, I want to know exactly what, Tesla's fair value is. Well, there's no way to do that. We could only create some assumptions about what are their earnings growth, what do we think is a high end? What do we think is a low end? What do we think, what is the sensitivity risks to things? And then we could compare that to other investments to see if it's undervalued or overvalued, right? So when we do that, when we do that with like something like, let's say Tesla, where's the fair value, right? Well, what do we compare it to, right? So again, don't look at this as like, this has to be it. This is just an initial, starting point, right? And when we do that, what we do is we compare it to say, like, what do we think the earnings will be just investing in the rest of the market? All right, because if we need to remember, I did a comparison here. This is if this asset earns this much and this asset earns this much, what should I pay to achieve parity? Remember, like how we're talking about here, what is parity, right? What is parity that they would put equal to the point where I don't care which one I'm invested in. I don't care if I'm invested in this one or I'm invested in this one. To me, with these valuations, it's the same thing. Okay, so I'm taking a couple concepts here. I'm taking earnings yield parity, and I need to create a forecasting model to go and forecast those earnings, which are very, very hard to do because, again, you're doing it with lots of assumptions that are continuously changing as new information comes in. All right. Hopefully I'm not losing you guys here. So with Tesla, well, how do we project, growth? How do we project it? Well, we could look at the last 3 years of revenue growth versus the last 3 years of SPY and just assume, well, what if both of them continued on that same path, right? So the revenues for next, 5 years, year over year, continued on the same path that we witnessed in the last 3 years. All right, that's what if we guess that? And what about their margins, right? Because earnings are based on what part of your revenue do you keep as earnings. So if we use the most recent margins, right? Tesla 11%, SPY 14%. If we did all that, right, then we could project earnings going forward, right? So these would be based on that. We could project every year how much would each one do. And then based on those earnings, right, we could say, okay, what would I yield? So I take the enterprise value, which is what it's valued at today, and said if I bought all the stock today, right, and I own it outright, all the SPY stock or all just Tesla stock alone, what would I yield at the end of 5 years? And then, you'll get a difference. So this way, if you say, well, if to make it the yield equal parity, right, what would I have to pay for Tesla to make it parity, right? So this would be earnings yield parity based on these assumptions, right? So I could start changing these assumptions and saying, well, I think that they're going to grow, Tesla's going to grow by 55%. And I think that 11% margin is too low. I think, Tesla's going to be 12% margin. And I think SPY will stay pretty much the same. I recalculated. So you can see I changed my assumptions. And now I got a different implied value. So with models, there's no way to precisely say, this is what the value is. What we're doing is taking inputs and saying that, well, if this and these are my assumptions, what do I think this should be worth in theory? Okay. And then we look at the market prices and say, well, okay, it's kind of in line there. It's in my bottom, my top and low range. Or if it bounced out of there, then you could try to, look at it further and try to determine if this is, way undervalued or way overvalued situation. So hopefully that walkthrough helped out.
Yeah, that is great, D. Thanks so much.
Right at night there. Yep.
Thanks so much. We do have just a reminder. I don't know if people have gotten the emails. I've sent out a few of them, but we have a webinar, I think, on Tuesday, right, with Interactive Brokers. Yeah,
Tuesday we're going to have a webinar with Interactive Brokers about implied volatility and historical volatility. It's at 2:00, and you do have to register with Interactive Brokers because they are hosting it. It's not going to be on YouTube. It's going to be, within the Interactive Brokers platform.
So I will put that link into the chat. Also, please thumbs up and subscribe to the channel below. That's always very helpful to us. Great job, D. You have a great weekend, my friend.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day and hope to see you guys on Monday.
Trading